Good day. In this lecture, we are going to talk about conditions for financial intermediation. This is the first module in the program of financial investment and risk management, and my name is Gianfranco Vento. So we will try to understand more in details what financial intermediation is. Financial intermediation can be defined as the process of channeling funds between those who have a surplus of funds and therefore they want to lend the money, and those who have a lack of funds and they need money in order to finance their investment projects. We know that in the financial system, typically we have some economic agents who have more funds than what they can use for their consumptions, and therefore they have a surplus. And those who have a deficit of funds because they want to run out investment projects, and therefore they need to borrow money in order to finance them. So financial intermediation can be defined, as I said, as the process of channeling funds between those who have a surplus and those who have a lack of funds. And the mechanism whereby surplus funds from ultimate savers are matched to deficit incurred by ultimate borrowers can be defined financial intermediation. What is the rationale behind financial intermediation? Financial intermediation is necessary in order to bridge a gap between deficit borrowers and surplus savers. And financial intermediation can be performed by using financial intermediaries or by using the direct lending in financial markets. In the case of direct lending, we have an economic agent who has a surplus, another economic agent who has a deficit, and therefore the one who has a surplus lends money directly to the one who has a deficit. On the other hand, in case we have a financial intermediary in the middle, the economic agent who has a surplus deposits the money in the financial intermediary, in the bank, and then the financial intermediary lend the money to the economic agent who has a deficit. So this is, in this case, we have a third party in the middle between the one who has a surplus and the one who has a deficit. So financial intermediaries are firms that pool the savings or investments of many people and lend or invest the money to other companies or people in order to earn a return. Obviously, financial intermediaries perform this task in order to generate profits. What are the most relevant financial intermediaries we know? Well, we have banks. Commercial banks are probably the best known financial intermediaries. But we can also have other financial intermediaries, like, for instance, insurance companies, pension funds, investment companies, leasing houses, factoring houses, and so on. So in the process of financial intermediation, savings are very important because savings is the part of income which is not spent on current consumption, and therefore the relationship between savings and income is called saving function. So saving is the portion of income that is not used for consumption and therefore can be used for investment or can be lent to those who have a deficit of funds. Typically, decisions to save are made independently of decision to invest. Financial intermediation is the process where firms that pool savings or investment of many people in order to lend or invest the money to other companies or people in order to generate a return. As I said, financial intermediaries are a large variety of institutions like banks, investment companies, pension funds, insurance companies. And the two channels I mentioned before through which financial intermediation can occur are known as direct lending or direct finance and indirect finance. In the case of direct finance, we have lenders or savers who have a surplus of funds, and they transfer those funds to the borrowers, to the spenders, by using the financial markets. For instance, a government which has, by definition, needs funds in order to finance investment projects, can borrow money in the bond market by issuing bonds, and therefore raise funds from those who have a surplus, who are typically households. On the other hand, the transfer of funds can occur through financial intermediaries. So in this case, those who have a surplus of funds, they deposit the money within financial intermediaries. For instance, they deposit the money in a bank, and then the bank lends money to those who have a deficit of funds, typically firms or government. In this case, we are talking about indirect finance or indirect lending. And in the case of indirect finance, of course, there is a different cost, because there is a cost of intermediation, but there are also several advantages. First of all, the risk of that the borrower is not able to repay the loan stays with the bank, stays with the financial intermediary. So in case the borrower is not able to repay the loan, those who have a surplus, they will be repaid by the bank. So credit risk stays with the bank, stays with the financial intermediary. On the other hand, a financial intermediary, they perform a maturity mismatch, and they perform also they perform several functions. The most relevant one is the maturity mismatch, which means that banks collect funds short term, and they typically lend money longer term. So this is done in order to make easier for borrowers to match the maturity of their investments. What are the most relevant services performed by financial institutions? Well, financial institutions, they offer information services. They provide information, they collect information in a professional manner, and they process those information. So this is a service performed by very relevant service performed by banks and financial intermediaries. They provide liquidity. They generate liquidity, especially banks can create liquidity through deposit multiplier, and they transform illiquid asset. They can help to transform illiquid asset in immediate liquidity. They reduce transaction costs, because banks and financial intermediaries, they collect information in a professional manner. They process those information, and therefore they make easier and cheaper to select a counterparty to finance and to monitor the counterparty over time. Financial institutions also make possible to have intergenerational wealth transfer. So they make possible to transfer funds from a generation to the following one. They have a very important role in credit allocation. So they are supposed to analyze in a proper manner information, and to make possible to allocate credits properly, which means that they finance those investment projects that have the lowest risk given a certain return, or the highest return given a certain risk. In addition to that, banks are typically they play a role in the transmission of monetary policy impulse, because all the operations performed by central banks, they are performed through commercial banks, in the sense that anytime central banks, they want to increase or reduce the amount of liquidity in the system, what the banks do, they put in place operations, some operations, typically open market operations with banks as a counterparty. So banks make possible for central banks to transmit monetary policy impulse to real economy. And last, some financial intermediaries have a role in payment industry, in payment services. They provide payment services. They make easier, they facilitate the transfer of funds among different economic agents. So here we have a list of the most relevant service of financial intermediation. As I said before, banks and other financial intermediaries make possible to have a maturity transformation, which means that some of those financial intermediaries, they collect funds short term and they lend money longer term. They do something that individual economic agents typically don't want to do, because those who have a surplus, they typically want to lend money short term, whereas those who have a deficit of funds, they typically need funds longer term. So there is the risk that demand and supply, they don't match. But if you put a bank in the middle, banks are able to collect funds short term and to lend money longer term. In this way, they can better assist real economy. Second, another advantage of financial intermediation is diversification. An individual lender who has a surplus of funds has a limited capability to diversify its portfolio. So if I have a surplus of funds and I lend all the money or a large portion of my savings in one counterparty, in one company, in case this company will not be able to repay the loan, I lose a large part of my savings. On the other hand, financial intermediaries, banks, they typically lend money to a large number of different companies, different counterparties. And therefore, in case one specific counterparty is in trouble, in case one specific industry is not going very well, all the other industries or all the other counterparties are supposed to go well, and therefore the losses are quite limited. So diversification is something that only large intermediaries can perform. Also, there is a cost reduction of information and contracting, because as financial intermediaries are professional agents, they are supposed to collect information in a proper way, to process information in a proper way, and therefore the cost in collecting and processing information is reduced. At the same time, the cost of contract preparation is reduced, because banks and other financial intermediaries, they typically use standard contracts. Also, financial intermediaries offer payment facilities, payment services, which is a byproduct of financial intermediation. I mean, as a part of financial intermediation, typically banks and other financial intermediaries offer payment facilities, which means that they make easier to transfer funds from one client of a bank to another agent. And also, financial intermediaries offer asset liability management services. So they try to integrate the decisions on the asset side with the decisions on the liability side of the balance sheet. And also, they offer liquidity of claims against financial institutions. They offer a number of instruments. They offer risk management instruments, like, for instance, futures, options, and swaps. I mean, financial intermediaries, they do not only offer financial intermediation services, but in more recent times, in the last 30, 40 years, financial intermediaries typically offer risk management services, which means that they make it possible for their clients to better manage risks, like for instance, currency risk, market risk, interest rate risk. How do they do it? They do it by offering them some instruments, like for instance, derivatives, in order to transfer a portion or in full the risk from the book of the client to the book of someone else. Also, financial intermediaries offer arbitrage instruments, and they make possible to perform asset-backed securitization, which is a technique which makes possible to transform illiquid assets that banks and other financial intermediaries have on the asset side of the balance sheet in securities, and therefore to sell those securities in the financial markets.